I love this. Control your destiny. What does that mean?
Controlling your destiny means doing things only because you want to do them, not because you have to. In a company context, that means having the right performance, having the capital, having the strategic plan in place so that you're not forced into a financing or a sale or doing anything from a position of weakness. I don't know if you're a Silicon Valley fan.
Oh, huge.
You might remember the scene when they're talking about revenue and Russ Hanneman comes in and he says, "Oh, we can't show revenue."
If you show revenue, people will ask how much and it will never be enough.
It's satire, but I think we smirk about it because we know there's a bit of a kernel of truth in that in many ways.
Triangulate your way to success.
They only take snapshots of your business. They don't see the whole movie playing out. Ultimately, you are the one operating your business, not your board.
You've told me that you're actually an operator and a leader more than a CFO.
Once you're on the leadership team, your job's to help the company win, however best you can. And sometimes that means going deep in your lane. Sometimes it means having a point of view on product or go to market, people, strategy. You need enough humility to know what you know, but the confidence to be able to speak about any of that.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to another very special episode of Run the Numbers. This is the third episode we recorded at the New York Stock Exchange. I didn't take a single bathroom break. This interview is with Jake Kornreich, the CFO of CoLab. Prior to CoLab, Jake was the CFO of Own, which sold to Salesforce for $2.1 billion. This guy had quite the come up. He started as chief of staff at Own, worked his way up to the CFO seat, and sold the company for multiple billions of dollars. He takes us through his 6-part framework for selling Own to Salesforce. It goes something like this. Control your own destiny. Share price equals entertainment until the day you sell. I love that one. Disciplined execution makes preparation a breeze. You get paid for performance, not stories. Triangulate your way to success, and stakeholder communication. All this and more. And if you want, afterwards, check out my deep dive on a CFO Explains the Stock Exchange. Jake, thank you so much for joining me at the New York Stock Exchange.
Great to be here. Thanks for having me.
A lot of marble to build this place.
They don't build them like this anymore, that's for sure.
So I want to start off with some quick hitters here. Do you remember the first stock you ever bought?
The first stock I bought was Amazon. I was day trading it in the back of a classroom, I think during a lecture my freshman year of college. Like, not my finest moment back then. It was books and Madden every year. I had no idea it would turn into what it turned into.
Do you think you still own that share or that stock?
If I had, I don't know if we'd still be sitting here.
When you think of companies ringing the bell, an IPO, I mean, we got the balcony behind us. We were asking before, how many people can they fit up there? They can fit up to 15 people. Do any companies come to mind?
I actually used to live about 3 blocks away from here on Liberty Street. Back and forth every day to the subway for work. I'd look down the street and I'd see the facade, the columns that, we've all seen, this beautiful temple of American capitalism. I just think to myself, man, I would love to ring the bell there one day, like actually earn the right to do that. And it's still something that motivates me today.
Yeah, I can't believe they even let me in the building. Do you think the benefits of going public are the same as they used to be?
I think the benefits are still the same. Liquidity, brand, currency, accountability. And I think accountability ultimately makes you a better company. You start running the risk of the market dictating how you want to run your business, and that becomes a very fine line that can be challenging to learn how to walk appropriately.
It's a good point. Like, you're running a company for the sake of whatever your board thinks is the best way to run it. And then once you're public, you're running it with the eyes of everybody on you. That can be a tricky thing to navigate, especially if you're a company that's making investments that take a long time to come to fruition.
The benefits are still there, but I think the bar for getting there is just much higher than it used to be.
The median of the last 14 or 15 companies that have gone public, it's like 830 million in revenue.
Which is crazy to think about, because I know when we were well on the path to doing that, I think SentinelOne comes to mind. I think they went out with like 150 million in trailing ARR, and we were getting close to that benchmark and starting the process. Okay, we've got to think about this. And then all of a sudden, the market reset and that bar kind of doubled and it doubled again. I think software is a little bit different than some other industries where it's more of a capital raising event. For software companies, I think lately it's become much more of a brand building, sort of a graduation or a coming of age, if you will, a milestone in the company's maturity.
I was running an FP&A at a hypergrowth company around that same time. And I remember bankers saying like, oh, if you're just on the path to 100 million in ARR, like you'll be good to go. And the multiples are so big at the time, like multiply anything by 50, you have a pretty big market cap, but like you're playing in traffic if those go down.
And that's exactly what we saw happen. I think we're still seeing the effects of that today.
30 years ago, there were about 8,000 publicly traded companies. It's now less than 4,000 in the US. If me and you are back at the New York Stock Exchange in 10 years, is it going to be higher or lower than 4,000?
You know, I'm always a little scared to make a prediction that far out. I think the trends are pretty suggestive that, as we just said, the bar for going public is much higher than it used to be. An IPO is more, a coming of age party than a capital raising event. If I were a betting man, it's always hard to bet against where momentum is going.
Yeah.
But we'll see.
We're going to dig into your recent journey at CoLab. You seem to be crushing it there. First, I want to get into the sale of Own to Salesforce, where you were CFO. This was an amazing ride. Before I get into that, though, did you start as chief of staff there? What was this come up?
I started at Own when we were about 13 million in ARR. I was doing a little bit of everything. The joke's always, chief of staff is a jack of all trades and a master of none. And to a certain extent, that was very true. The CEO had really been a one-man FP&A operation running the business with the model that he had built from the last company that he had sold. And fun fact, we actually used that exact same model through 2023. We put a lot of things on top of it and it matured in many ways. It was a lot more complex, but it was still the same basic framework. I was an investment banker. I can kind of work my way through a model, through a spreadsheet.
Yeah.
COVID happens. We're caught in this hypergrowth phase. We're hiring like gangbusters. We had no idea whether this was going to be the best thing that ever happened to the business or the worst thing. I just kind of kept running to where the fire was. And, that year plays out. Then we found we couldn't hire fast enough. I, believe it or not, started running HR.
So you're doing HR before you're doing finance?
Finance, then HR, then kind of back to finance. I thought it was going to be a quick thing. It was 15 months. I had built the operating model and I knew what the numbers were supposed to say and how we designed it. Now it was time for me to actually go execute on that model. I can make a spreadsheet say whatever I want it to say. Is it actually realistic? So it was really eye-opening to go have to actually execute a plan that you played a large part in building. We simply weren't hiring fast enough. And the way that we modeled the business was based on quota and headcount. So both the revenue top line and the bottom line were all predicated on hiring. And that was going to be the biggest lever and the biggest inhibitor to our growth. And I stepped in and I thought, what can I actually do? How can I pull the right levers to accelerate hiring? And I thought about it just like it was a sales problem. We're selling jobs instead of selling software. How do I talk about and how do I get the teams to talk about recruiting like it's a sales org, like it's RevOps? So started talking about everything in the context of a funnel, top of funnel, how do we move people through the funnel, time to hire, just like a sales cycle length. It was the same metrics we were operating one part of the business with, same principles, which we were super good at. How can I apply that to a different area of the business? And I think at the peak, right before I gave the roll up to a proper CHRO, we were hiring like 90 or 100 people a month.
Own was one of the few COVID era unicorns that earned, and I'm using the word earn because you really did, a successful exit to a large strategic. The sticker price was over $2 billion. You shared 5 themes with me as you reflected on that journey. Would you be game to walk through each of these?
Love to.
All right. So the first one, I love this. Control your destiny. What does that mean?
So to me, controlling your destiny means doing things only because you want to do them, not because you have to. So in a company context, that means having the right performance, having the capital, having the strategic plan in place so that you're not forced into a financing or a sale or doing anything from a position of weakness.
In great companies, they're bought, not sold.
I think it means the best outcomes usually happen when the companies are in some sort of leverage. If you have to run a process because you're out of options, the market can feel that, your employees can feel that, an acquirer, an investor can feel that. It puts you in a much different position than when you're doing it from a position of strength. You have almost emotional leverage where, hey, if I just don't like how this deal is going to come out, if I don't like the math, if I don't like the synergies, if I don't believe this is the best thing for the business, I can always walk away.
How much did the synergies matter?
Tremendously. Salesforce is a serial acquirer, really mature M&A org. They've done this a few times before, really large scale. And, at the time, they had activist investors in their stock and a really tough board. So we absolutely had to make a case that 1 + 1 = 5. One of the things that we had going for us was the fact that we had this long-term partnership with them, both by way of the Salesforce Ventures investment. They were around from some of the earliest days of the company. We had tight go-to-market partnerships, really close relationships through their R&D org. So there was a lot of connective tissue, which meant the synergy cases that we were making weren't theoretical. The proof points were already there.
Hey, thanks for listening. We'll be right back after a word from our sponsors. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations, woo! Everything a scaling company needs. They've got 5.0 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me. Maybe the first thought you had when you started a tech company wasn't about scenario modeling or runway management or the fine print of an S1. I love a good S1. That's not where the magic happens. It's more fun to build something new, design your quarter zip, or network with VCs. But what if you got your financials right early, long before your investors started asking for it? There's no limit to how far you can go and how many headaches you could stave off. Now, that's where EY comes in. EY has been a part of Silicon Valley since, well, it was just a valley. And it's helped some of the most successful names in tech go from startup to exit to mega cap. You build the next big thing, and with the teams across strategy, tax, audit, and transactions, EY will help you build your next big thing right. Learn more at ey.com/tech-startups. That's ey.com/tech-startups. Let me ask you something. If your board wants financials, would you be certain you're not wasting money on SaaS? Or if a major renewal hits, would you know if you're paying a fair price? Your vendors would. They see thousands of deals every year, but most finance and procurement teams see one deal at a time. That's a tough way to negotiate. SpendHound fixes that intelligence gap. It's one place to track all your software spend and gives you pricing benchmarks across more than 10,000 SaaS and AI vendors. And it's based on real spend data from over 8,000 companies. SpendHound connects to your financial systems and shows every software dollar you're spending. Contracts, renewal dates, overlapping tools. Nothing quietly auto-renews, and you don't pay twice for duplicate tools. SpendHound is the #1 rated SaaS spend management platform on G2. It's trusted by teams at ZoomInfo, Hootsuite, and Kit. Free forever, wow, for SMB and only $10,000 per year for enterprise with $150,000 savings guaranteed. If you want to stop negotiating blind, go to spendhound.com/CJ. That's spendhound.com/CJ. Trusted by over 1,000 finance, ops, and procurement teams. You've told me that as a CFO, you have to diligence your own ROI. I think that's a cool phrase. What does it mean?
I think the first is strategic ROI. So anytime you're entering a new market, launching a new product, you want to make sure you don't have shiny object syndrome. You're doing it for the right reasons and there is a real return behind it, not because somebody thought it was a good idea. Maybe a customer.
It's that one loud customer.
It can always happen and it's very real. So you want to make sure that you're not just doing what the market wants to hear. You want to make sure you're doing what's the best thing for the business. Second is operational ROI. And I think this happens on a much more regular basis for any CFO or finance leader who's out there and really need to be very disciplined about it. I would find a lot of times that folks would come to me looking to buy a piece of software. And I always ask, is this a people, process, or a technology problem to make sure that, okay, are we solving the right problem here? And when the market reset in 2022, and by the way, I took the CFO role full time during that market reset. So I picked a really hard time to take a really hard job going from hypergrowth. I came in, we ripped the tech stack apart end to end and really asked ourselves every single time, do we need this to run the business? And if it wasn't AWS, my ERP, my CRM, the stuff that in this physical universe we can't operate the business using. We had to come back and have a really strong ROI case that this absolutely makes the business better.
Hard to do in practice.
It's not easy, but it's something I still do today.
Next one I got for you. Share price equals entertainment until the day you sell. I think I'm going to make t-shirts after this interview with that one on there.
I think I borrowed that from Frank Slootman. I'll give him the credit for it, but it just stuck with me. Whether you're in the private markets or the public markets, your share price is a signal, but it's not ultimately liquidity. And the only price that ultimately matters is the price on the day that you transact. And in 2020 and 2021, there were a lot of companies that were chasing the next valuation in the market. It looks really, really good in a press release, and you run the risk of not meeting the expectations that you set for yourself.
It's self-inflicted sometimes.
It is. And then you can put yourself into a really tricky box that creates a ton of problems for future you.
I find that people who aren't in the finance department sometimes assume that what you raise at means that's what you could sell at. I believe those can be two very different things.
Two very different things. And it's not just what you could sell at in the public markets too. If you're selling to a strategic acquirer, don't forget they have a synergy case, and it's not what it might be worth to you or to someone else in the market. It's what it's going to be worth to them.
The more you raise, the more complex your cap table is. Walk me through that.
One thing you really want to avoid is playing games with headline valuation. Don't force a number. Don't force structure.
Change the denominator.
You need to accept, sometimes what the market's telling you. There are moments where it might be better to take a slightly lower price or maybe a little bit more dilution, but it can give you cleaner terms, give you a lot more flexibility, and going back to the controlling your own destiny point doesn't create problems for the business down the line.
So playing games, it's not worth it.
Not usually.
Just take a clean term sheet.
I much prefer sleeping better at night.
Disciplined execution makes preparation a breeze.
You can't start exit readiness the second a buyer shows up. You're taking the exam, you have no chance to study anymore. And at Own, we always tried to run the company with the same discipline we'd eventually need, whether it was for a financing or an IPO or an acquisition. So that meant always having clean metrics, good systems behind those metrics, and a cadence where the business was being reviewed the same way every quarter. We would have an ops review, and the ops review would turn into the board deck materials, and the board deck materials would be the same things that we might share with an investor or put in a data room. And we raised almost $500 million without a traditional pitch deck because the story that we had put into those materials did everything that we needed it to do.
And it sounds like it's kind of like measure twice, cut once. A lot of these metrics are portable, and you're speaking to the exact same metrics that you're using operationally that you prioritize to the people who are your stakeholders. I've seen a lot of companies that get over their skis where they try to look cute with the metrics they share externally. It's really hard to keep that straight.
It is. And when you can be very transparent and you can go in front of somebody and say, I told you I was going to do X, I did X, not Y. That gives you a tremendous amount of credibility, and it's absolutely priceless.
You get paid for performance, not stories. This is a good one.
I don't know if you're a Silicon Valley fan.
Oh, huge.
So you might remember the scene when they're talking about revenue and Russ Hanneman comes in and he says, oh, we can't show revenue because the minute you show revenue, it's never enough. It's satire, but I think we smirk about it because we know there's a bit of a kernel of truth in that in many ways. Early stage, the investor questions that you get are more about belief. What do people want to believe about the market, the product, the vision? Later stage, it becomes a lot more forensic and formulaic. I remember going to some of these investor conferences, especially when you start talking to the long-only mutual fund managers, the hedge fund managers, and the folks who are just much more into the numbers. And you might get a question and it's, something 3 lines buried deep into your model, or they're asking about a metric that you talked about 6 months or 12 months ago. And you're thinking to yourself, I forgot that I said that. Or they might say, you said you were going to grow this thing 2%, you only grew 1%. Why? And I'd say, well, I'm still a growth stage company. I don't know. We might miss a number because my CRO woke up on the wrong side of bed one morning. But it was a real eye-opening experience just to see what being a public company is really like and what those expectations are like and what having to do exactly what you said you were going to do feels like.
It's a great call out that the metrics, not only the metrics, but the lens that you're put under in a later stage company, when you talk to these crossover funds, there's some 25-year-old analyst who knows what you said 6 months ago, and they're going to ask about it and bring it back and put it back into their own model. Jake, earlier you mentioned activist investors. Why does that matter for an acquirer and therefore matter to you?
So the acquirer has their own shareholders, their own board, and their own narrative that they need to manage. And Salesforce wasn't just deciding whether they liked Own as a business. Their management had to be able to communicate that story to their board and make that case to their board, and in turn, eventually the public markets. Why does it make strategic sense? Why does it make financial sense in the context of whatever they've already communicated out to the market? When you have an activist investor in their stock who might be enforcing some more discipline around capital allocation, it just means when there's a meaningful acquisition on the table, they're going to be a lot more thorough about it during their process.
Well, just to play this through, it sounds like you took it on yourself to arm them with the information they needed.
I always thought like an investment banker, even when I wasn't after the fact. That's one of the reasons why we were so prepared going into the deal or any capital raise. And it was exactly the same story going into the acquisition. The deal thesis has to be very clear. I always approach a capital raise as if I wanted to write the investment memo for the folks on the other side of the table.
Yeah, let me do it for you.
We understand what your strategy is. We know why this makes sense because we talk to you all the time about it. And how can we help make that a much more cogent story? What information do you need to actually prove that out?
Hey, thanks for listening. We'll be right back after a word from our sponsors.
The CFO role has evolved faster than the tools built to support it. Most finance teams are still running infrastructure designed for a job that no longer exists. The reporting, the reconciling, the close that bleeds into the next month or quarter. That's not finance, that's overhead with a really crappy title. And the cost isn't just your time, it's everything your best people aren't doing while they're buried in it. Agentic finance shouldn't multiply your output, it should eliminate the work that was never worth doing in the first place. And that's why I run mostly media on Brex, an intelligent finance platform with AI-powered agents that capture expenses automatically, enforce policy before the spend happens, and close your books in minutes instead of weeks. 35,000 companies like OpenAI, Coinbase, Anthropic, and DoorDash already run on Brex. It's time to get Brex AF. Learn more at brex.com/metrics. I've seen a lot of FP&A tools, and Aleph is one of the few that gave me that aha moment within minutes. I remember watching their founder, shout out to Albert, connect my NetSuite data and build me a full P&L live in minutes. Aleph is now trusted by hundreds of leading companies. I've had the CFOs from Turo, 8 Sleep, Zapier, and more on the pod, and every one of them is a huge advocate. I also just published my second annual CFO Tech Stack report, and Aleph has been on the podium both years, including a #1 finish in the $50 to $100 million segment this year. Instead of being just another planning tool, they built a real enterprise-grade data foundation for finance, implemented at startup speed with AI-native workflows woven into its DNA. All your systems, ERP, CRM, HRIS, ATS, product usage, and more, powering one clean, governed data layer that finance can actually trust. And with AI moving as fast as it is, they're pushing even further. MCP, custom AI chatbots, AI-powered variance analysis, and the list keeps growing. Try it with your own data at getaleph.com/run. That is GETALEPH.com/run. Tell them CJ sent you. Here's a growth tax that nobody talks about. Every new pricing model you ship creates a nightmare for your finance team. Usage-based pricing, now you're tracking usage against commitments. Product bundles, now you're untangling what to recognize and when for every line item. Mid-cycle upgrades, good luck manually reallocating revenue. The pricing strategies that drive growth are the same ones that break your finance process. RightRev turns that irony into a competitive advantage. Your product team can ship new pricing without asking finance for permission, and your sales team can close deals without worrying about downstream chaos. But I've seen too many companies where sales are celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. It's actually me. So here's a good place to start. RightRev built a free tool at calculator.rightrev.com. It scores your RevRec process, shows what's exposing you to risk, and tells you exactly where to focus before it bites you in the rear. Probably explains why your last close took so long. Check it out at calculator.rightrev.com. All right, without the Boston accent, calculator.rightrev.com.
I'm feeling another Silicon Valley reference in here. Triangulate your way to success. Gratuitous, yes. They're not the conjoined triangles of success. There's so much benchmarking, there's so much data, there's so much content out there. These things are not a script. They're just a formula. You can't paint by numbers your way to success. Can't be top quartile on every metric at the same time. If you're trying to optimize everything, you're probably not making real strategic choices. We used to use benchmarks to put guardrails on the plan. Okay, roughly speaking, where do we think we need to be? We go off and make a plan based on what we knew we needed to accomplish. And then we would use the benchmarks again to sort of gut check, what trade-offs are we making? Did we make the right trade-offs? Do we understand holistically how our capital allocation decisions will ultimately create value? And we had a lot of great board members. Their pattern recognition is an invaluable resource. But at the end of the day, they only take snapshots of your business. They don't see the whole movie playing out. Ultimately, you are the one operating your business, not your board, not your investors. And you need to understand what actually makes your business tick and what actually creates value at the end of the day.
Can you just go a level deeper on that? Because I think it's an important message to people who are running a business and they get really nervous before the board meetings. You know, they've done their prep. They've worked in this business day to day. What would you say about just having confidence in being there and just saying, hey, I know this better than anybody else?
I remember our CEO always telling me that I would almost script out my talk track before a board meeting.
I would literally script it out. It would be in the speaker notes.
And one time, I don't remember exactly why I didn't do that, whether it was I just didn't have the time to prepare or I just decided to do something different one day, but I just came in and I can't say that I winged it. I just went in and I talked about the business the best way that I knew how. And he came out after the meeting and he said, you were just naturally you and you weren't trying to perform. And it was so much better because you know what you're talking about. We can sit here, we can look at all the metrics all we want. We can soak up great content, podcasts and newsletters and blogs, and you talk to other operators and try to learn and be a sponge as much as you can. But again, at the end of the day, you're the one who knows your business the best. Collect data points, try to do some pattern matching, but on the outcome.
How did you know it was the right time to maximize value for your shareholders?
It's not, hey, this is the time we need to sell. It was sort of like being an athlete, you know, who gets to the end of their career and they always say, you know, I'm not ready yet, but I'll know when it's time. We sort of felt the same way. You know, when you know, you know. We had a really strong bid from the best possible strategic acquirer. With the benefit of hindsight, the IPO markets are, for all intents and purposes, still pretty shut for software companies. Sponsor activity has been pretty muted and strategic activity has been pretty hit or miss too. The question for us became what outcome best balances investor interest, employee interest, customer interest, and the long-term value of the company. And we felt that the deal that we had on the table did that, turn years of work into real value for our shareholders, for our employees, and it put the company in a place where what we built could continue to matter.
I think what a lot of people don't realize is the valuation number that you take on can also become a limiting factor in terms of your exit opportunities. Like, that's amazing, 2.1 billion. But there aren't many companies who can write a check for 2.1 billion. So I used to joke with like security companies, like if you get so big, like eventually it's only Palo Alto or Google can buy you.
That's exactly right. So again, it always comes back to controlling your own destiny.
Okay, one more here. Stakeholder communications in an acquisition. What was the very first message you gave to employees when you knew this was going down?
I think it was a mix of pride and gratitude. The end of the process was super intense. And I remember the ELT and the deal team and some of our board members, we were in this room having a sort of a private moment once we knew that the docs had all been signed and we were waiting for the deal to cross the wires and news started breaking. People are getting text, what's going on? So we opened the door and everybody's streaming up for this last minute town hall that we had put on the calendar. And generally it was a lot of excitement, a lot of elation. I think people sort of suspected something was going on, but weren't really sure about it. And, there was a lot of pride in that moment, but there were certainly a lot of questions. So the first message that we delivered was, hey, this is a really big milestone. It's a testament to everything that you've built, but there's also a lot of stuff that we don't know. And we're going to be as clear and candid as we can be throughout the process, because I think people can handle uncertainty. They don't like being spun.
Humans, though, if you don't give them the narrative and fill in the details for them, their mind will go to a place of filling it in with stuff that may not be the best.
But we had the benefit of working with an acquirer that's, again, done this quite a few times. And so they had a really good playbook to run. Employees always want to know, why is this happening? What does it mean for the company? What does it mean for me? What does it mean for my job? What does it mean for my equity, my customers?
So you had all of that prepared.
We didn't have it all prepared, but We communicated very clear timelines that said, hey, these are the steps that, we're going to follow throughout this. There is a process to this. And by the way, we announced the deal in September. It's the beginning. We were on a calendar fiscal year. So this is the beginning of Q3 and Q4, which are pretty strong for us. We were going into this period between signing and closing the deal where, it could impact the end of it. It turned out to be a huge tailwind for us and a great kind of marketing opportunity, but it just added another element of uncertainty to an important time for the business.
Talk to me about talking to customers.
That was one of the hardest points. It's just everybody's excited about the deal and you don't want them to get distracted. It turned out to be a huge amount of momentum. And in our case, it became a helpful tailwind because they lived and breathed the ecosystem and they understood this would put a lot of confidence around the business and we were going to be a long-term partner.
This framework's amazing. I'm going to write about it, by the way. I want to talk a bit about your career path and what you're doing at CoLab now. We covered your come up from chief of staff to CFO to sitting here with me now. But you've told me that you're actually an operator and a leader more than a CFO. And that was something I really grasped onto because it resonates with me. I never thought about myself at first as I aspire to become a CFO. It ended up being what I was doing and I loved it. But I think there's a type of person who sees the CFO seat as a way to make change and it just happens to be the title.
I didn't grow up saying one day I want to be a CFO. I wanted to be in the room where important decisions were being made and where I could play a really significant role in what was happening with the business. Finance became a language I could use to do that. I just found I naturally thought that way and my mind gravitated towards thinking about value creation and trade-offs and capital allocation and risk and execution. But I never thought of myself as only a functional leader. And at Own, we used to say we were a team of leaders who happened to be on the leadership team, happen to represent a functional area, not we're a bunch of functional leaders that happen to be on the leadership team. And I think that's a really important distinction to make. And that's how I've always tried to operate. Once you're on the leadership team, your job's to help the company win however best you can. And sometimes that means going deep in your lane. Sometimes it means having a point of view on product or go to market, people, strategy, sometimes culture. You need enough humility to know what you know, but the confidence to be able to speak about any of that.
It sounds like you were prioritizing for impact more than role.
Absolutely. And I think at the end of the day, the title gives you a mandate, but the impact comes from how broadly you can actually help the company make better decisions. I think that's what being a CFO is all about.
So you chose to make CoLab your next challenge. I'll start off with an easy one. What is CoLab?
Our customers build the physical world around us, cars, aerospace components, medical devices, energy infrastructure, industrial equipment, all the stuff that helps make the modern world operate. CoLab helps the engineering teams that design those things make better decisions faster.
Got it. I saw actually some motorcycle companies too on there. What attracted you to this industry opportunity after the Own acquisition? I'm guessing you had some choices to make.
I had a couple and I looked at taking on a new role a bit like being an investor, except I only get to make one of these decisions every couple of years.
You have one buy button for the next 4 years or more.
That's right. So it makes the stakes feel just a little bit higher. After Own, I wanted 4 things. I wanted a great team, a large market, real customer pain, and a company where I felt like I'd really materially be able to impact the outcome. And I found all of that at CoLab. The team had already been through a lot of the early company work that comes from early days. The culture was super strong. The market was enormous and the problem felt very real. Engineering teams have been working with tools that haven't changed very much, at least not as much as the rest of software has. And so it felt like it was a really ripe opportunity.
Talk to me about the time. I think you joined after Series C. Is that right?
I did.
Why is that a good time for a CFO to join? I'm assuming that there's some stuff that has been figured out that's good, right? There's a balance sheet that you can check and stuff before you get on board, but it's also a pretty messy time.
It's still super messy. And I had the benefit that CoLab was about the same scale as Own was the day that I had joined there. So I sort of knew what I was getting myself into. I think it's a great stage for me because the company is big enough that the problems are real. And a lot of that early stage stuff is behind it, but the operating system is still being built. And that's really what I was brought in to help do.
And just to play it back, because there are a lot of people listening to the podcast who may be trying to get either their first CFO role or they're going for their second or third and they're assessing the opportunities that are out there. It sounds like there's a stage that certain people have almost like personal product market fit of like, this is a good size company for me to join.
Yeah. And we saw that a lot actually with a lot of employees through our journey at Own as well, where there are folks who are really good at 0 to 1 stuff. They might be really good at the 0 to 10 or maybe the 10 to 100. And I think that's okay. You can do that a couple times and actually build a pretty good career. One of the things I'm proudest of was scaling from about 10 million in ARR to almost 300, and it got to the point of the exit. And it was like we were running a different company every year, and the challenges are all a bit different. You try to keep the same operating system in your head, try to keep things simple, but the challenges you face along the way can be very different. And some people enjoy that challenge, and some people enjoy having to change how they do things. For other people, maybe not. So if I was giving advice to somebody looking for that first role, I don't think there's a one size fits all answer. Find a way in, figure out what you like, and go from there.
This funny thing happens though when you have success is you get an opportunity to play what I would call a bigger game. Like, hey, you're the 10 to 300 guy. Do you want to be the 300 to a billion guy? It sounds like you said, I really enjoy this stage.
There's a lot that went into that decision. I think if you had asked me going into the search what I was looking for, I had my sights set on let me continue what I was doing, but the opportunity that CoLab presented was just way too good to pass up. I really felt so passionately about the product. I really felt like I vibed with the team there really well. And again, it all came down to that's what really gets me out of bed every morning.
I love that. Jake, I'm going to take you into what we call our long ass lightning round. So you've sold the company for 2.1 billion, but you had to give me one thing you've messed up on the job before.
Nobody likes airing their mistakes in public, but I actually find mistakes are how you learn. So when I was chief of staff, I sat right outside CEO's office. I had like a $5 million bust in a budget model. I think it might have been after the board meeting and the budget was approved. I'm like, oh no. But I didn't really hesitate or think twice about it. I walked right into his office. I said, look, here's what happened. Here's how I think we can fix it. I think the way that I presented it in that context was, hey, okay, I trust you. I don't think there's any other way I could approach that problem.
There's something to be said about the credibility you build by letting bad news travel fast.
You have to. At the end of the day, you have to own your mistakes. It's not about what you did. It's about how you respond.
If you could tell your younger self something, knowing what you know today, what would you tell him?
Follow your own path. Don't worry so much about what other people are doing. We talked about benchmarking, and you can do the same thing in your personal life or when you're managing your career. And it's important to remember that you're marching to the beat of your own drum. Everybody's making different decisions with different contexts. So take the advice, but put it into your own personal context.
And don't sell that Amazon stock that you sold for beer. Can you walk me through your finance software stack? What are you using today at CoLab to get the job done?
Pretty lightweight today, coming in at the stage that we're at. It's a very enterprise heavy business versus Own, which is a little bit more transactional. So we have NetSuite, we have Salesforce, we're using Navan and Expensify to manage expenses, Xylo, which happened to be the last thing that we just bought. I've been looking at the business perhaps differently than I might have a year ago, where I might have tried to rebuild the entire tech stack that we had at Own because it's what I know. But in this scenario with a smaller customer base, I can actually wrap my arms around the business. And it feels like an awesome opportunity to start figuring out ways where AI can change the finance org. So we're doing that in bits and pieces. It's amazing how much more productive I've just personally been.
Anything you found?
There's plenty of things that are out there that are interesting to us. Right now, we're just focused on getting the trains to run on time.
Last one I got for you. What's the craziest thing you've ever had someone try to expense?
So I don't have any particular stories or anything like Super Bowl tickets or a haircut. I was much more focused on driving a culture of discipline within the org. And at Own, I made it very clear that I was holding managers accountable to what was going through the system. They were aware that I would spot check certain things from time to time, and I had my ways of driving that accountability through the team. It's not one expense that's going to break the business. It's a culture of not using your capital the right way. And it was important to me that everybody viscerally feels where each dollar is flowing through the business.
You will sit in middle seat. We will like it. Jake, this has been an absolute blast. Thanks for carving out time from your busy schedule.
Yeah, thanks again for having me.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.